Hey everyone, Nick here. This is Chipstock Investor, and this video brings me no pleasure in recording what is going on at Intel. I'm sure by now you saw the fourth quarter 2022 earnings report, which was basically at the bottom of what Intel had projected it would be. And then the first quarter of 2023 outlook, which was atrocious. It was bad, but not completely surprising. As I've stated on this show before about Intel, the company is being divided and conquered. We are witnessing an empire in decline. But I think there are some really important things to bear in mind here if you are an Intel shareholder or you're thinking about becoming one because you want to bet on the company eventually rebounding. Because I think there's some disrespectful commentary taking place on the earnings calls that I think need some clarification from an outside perspective. So I apologize if this comes across as a tirade. It's only partially that. This is what I feel like is just some much needed objectivity on what is going on at Intel right now. So here goes. Before continuing, let me remind you to hit the like button and subscribe to the channel if this video is helpful as you do your own investment research and increase your knowledge of business and technology. We really appreciate the support, as subscribing to the channel helps us continue putting out content like this. Okay, so let's start here with Intel's at a glance sheet on the fourth quarter, 10,000 foot view on what's going on. But let's look here in the left column. They have this little pie chart showing the $14 billion in revenue from Q4, 28% year over year decline, broken down by segment. So these segments have been overall stagnant or in decline for years, which is an illustration of why the saying, make hay while the sun is shining, is so important. Intel's competitors like AMD, NVIDIA, and a long list of others have been growing the last few years while Intel has been in overall stagnation. Now the economy hitting a bit of a speed bump, specifically with consumer electronics. And you can see what that is looking like now for Intel. In the client computing group, their biggest revenue generator, down 36% year over year. Because this is their largest revenue generator, it hurts much more for Intel than it does for a company like AMD or even NVIDIA at this point, which have put in the work to become an enterprise or big business, large enterprise focused business first, consumer electronics business second. This stings for Intel. Now moving down to data center, this is the primary growth driver now. This is now the secular growth trend in the market. And CEO Pat Gelsinger has said now for quite some time that Intel actually fully expects to lose market share in this segment. And while they sure are delivering in that department, down 33%. Then there's network edge, which is flat. It did $8.9 billion in revenue for full year 2022, but Intel, in an attempt to try to cut costs and save money headed into 2023, exactly what you do not want to do if you're a technology company trying to play catch up to others. You don't want to cut costs, but they've said they are going to stop investing in network and edge, which is fantastic news if you're a company like Broadcom, if you're a company like Marvell Technology Group, MaxLinear, again, even AMD and NVIDIA at this point. There's now $8 to $9 billion in extra annual revenue up for grabs because Intel has now said they're gonna basically turn this into a cash flow generator, no longer investing in network edge. And then the other segments we can leave for another time. I just wanted to start with this high level view here. And looking at the guidance for the first quarter of 2023, things are going to get worse before they get better. Revenue expected to be down 40% year over year in the quarter. That puts Intel on track for annualized revenue of about 45 billion dollars, which is almost half where it was just a couple of years ago. Gross margin of 39% on products sold, way off of the 51% or so ish targets we were told to expect. Earnings per share negative. More importantly, the company ceased providing any type of full year guidance. That contrasts with a lot of other chip companies, actually, basically every other chip company that's reported up to this point, that says the first half of 2023 will remain in decline as excess inventory in consumer electronics is burned off, and then return to growth the second half of 2023. Intel's not ready to give us any guidance on that, but there were enough hints on the earnings call that suggested that specifically free cash flow. Please ignore the earnings per share. There's some financial changes, some accounting changes that are going to be made on depreciation of equipment that will start in 2023 that will affect earnings per share positively. It will skew earnings per share positive for Intel. But free cash flow, there's more than a good chance free cash flow will stay negative in 2023, at least through the first half of 2023, and perhaps not recover enough this back half of the year to turn the full year free cash flow, real actual operating profitability positive. That also puts, for those of you that are looking at Intel's dividend, puts the dividend at risk. Intel shelled out nearly $6 billion in cash in the last year for its dividend. If they're looking to cut costs, that thing has got to go. So I would not also buy the stock because you think it pays a great dividend. Now, I want to focus on some of the longer term guidance that CEO Pat Gelsinger and the management team have been promoting in the last year, including on the fourth quarter 2022 earnings call surrounding the client computing group. So again, I think this is really important because at this point, this is Intel's bread and butter. Big revenue declines, operating income down to a rate that is well below where it should be, even in a cyclical slump for the semiconductor industry. Intel has this goal for 5 manufacturing nodes in 4 years, basically because Intel is an integrated device manufacturer. They design the chips, they also manufacture them. They're rolling out new chip designs and playing catch up with companies like AMD and trying to catch up to the manufacturing capabilities of companies like Taiwan Semiconductor Manufacturing, TSMC. I have some issues with that. At this point, let's say Intel is able to pull it off. I don't necessarily think that is a bullish argument for the case of Intel, because even if they are able to pass up AMD again in client computing, Apple is designing some really incredible computing chips for its MacBook lineup that I don't think x86 architecture that Intel relies on is going to be able to catch up to at any point. So all of this talk about 5 manufacturing nodes in 4 years, honestly, it will probably help Intel, but I think it's more of a bullish case for owning ASML stock. ASML being the company that will supply the EUV machine for Intel to make that manufacturing catch up even possible in the first place. So more of a bullish case for ASML, or even a company like Synopsys, which we've started covering here as well. It ranks Intel as one of its largest customers for its chip design software suite. If Intel's able to pull all of this off, I'm sure it will help, but I'm not sure it really makes the case for Intel stock, for owning Intel stock. It's more of a case for owning other companies that are going to scoop the most profitable part of that manufacturing catch-up phase off the top and leave Intel with, maybe more revenue than what they're projecting here in the next year, but maybe not as profitable a revenue stream as it used to be because of the really, really substantial competition, not just from AMD, but again, from Apple. In short, with earnings per share now negative, free cash flow negative, we're not sure when that will change. Intel stock was not cheap, still isn't cheap because it's not profitable, no longer a profitable business. The dividend really should be at risk if the company is interested in cutting costs so that it can funnel money in the right place, getting its business back in order. The dividend has to go. $6 billion a year for that, not sustainable. I don't think Intel has an investor base at this point. This is a value trap stock for 2023. And until there is more meaningful progress, I think this is a dangerous business to add to your portfolio. I think there are other companies that are managing economic weakness, geopolitical issues, potential recession in 2023, the slump in the semiconductor market, you name it. There are other companies managing this much better. That's where I would start before taking a look at Intel for the portion of your portfolio you want exposed to the semiconductor market. That's enough of my rant. If you have some compelling reasons to believe Intel is a great buy at this point, hit me up in the comments below. Please, though, let's save the commentary that was used during the earnings call. If you have a fresh perspective, a fresh outlook on what could go well for Intel, what could go its way, hit us up in the comments below. There is a lot of information to unpack, though. We're going to have probably some more videos on this next week. So hit the subscribe button. I'm going to bring in some other perspectives on this as well, on what all this means for Intel and maybe some better alternatives as well where investors can look. So make sure you subscribe, and we'll see you all again soon. Take care.